Imagine it's 31 July 1914. You are a 34-year-old shipping clerk living in London, United Kingdom. You rent a narrow brick house in Stepney with your wife and 2 children, and on the mantel above the stove sits a small tin box holding your savings in sovereigns and notes. Each morning you button the same dark coat, walk past carts and horses, and take your place near the docks, where cargo lists from Hamburg, Antwerp, and New York feel as regular as sunrise. The world seems knitted together by steam, telegraph wires, and invoices, as if distance itself has finally been beaten into obedience. Your wages are modest but steady, and that steadiness feels like a kind of wealth, the way a solid bridge feels safe even if you never inspect the bolts. War is something printed in foreign columns far away from your table, your rent, your children's shoes, and the ships you expect to unload next week. If you have ever wondered why events in distant straits, borders, or deserts can suddenly reach into your kitchen drawer, stay with me. What you are about to hear is not a theory, it is a pattern. It has happened before. And it has a way of exposing how the economy really works. And if you find value in this kind of historical clarity, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Then before noon, the floor gives way. The London Stock Exchange shuts its doors on 31st July for the first time in its history. Banks begin rationing gold. Queues form outside the Bank of England. Credit tightens, which means promises that looked solid the day before suddenly cannot be turned into cash. Ships still exist. Warehouses still exist. Men still show up for work. But the invisible web holding the system together has started to tear. That is the heart of this video. When people talk about the economy, they usually talk about interest rates, wages, home prices, and stock markets. Those matter, but history shows that another force often sits above them all, quietly shaping each one. Geopolitical risk. That means the risk that war, sanctions, blockades, diplomatic breakdowns, state pressure, or attacks on key trade routes will change what a country can buy, sell, ship, insure, borrow, or trust. And right now, that force has moved closer to the center of economic life than many people realize. Not because the world has suddenly become dangerous, the world was always dangerous, but because modern economies are built like long glass pipelines. Energy crosses borders, food crosses seas, parts cross continents, payments cross banking networks. A shock in one choke point can echo through factories, grocery stores, pensions, shipping contracts, and family budgets thousands of miles away. Collapse is rarely a lightning strike. It is more like a pressure wave moving through pipes you did not even know were connected. Before we go further, there is something important to understand. Geopolitical risk becomes economically powerful when it hits 3 things at once: supply, trust, and time. Supply is the physical part. Oil cannot arrive. Grain cannot leave port. A cargo ship must sail the long way around a continent. Trust is the financial part. Banks become cautious. Insurers raise prices. Traders demand a bigger safety margin. Investors pull money back home. Time is the silent killer. A 10-day delay for one ship sounds manageable. A 10-day delay across thousands of ships is like sand poured into an engine. Inventories thin out. Factories wait. Store shelves empty. Prices begin to rise not only because goods are scarce, but because nobody knows what the next shipment will cost. Think of the global economy as a city supplied by aqueducts. When the aqueducts are open, people stop thinking about water. They worry about other things. But when a gate closes upstream, the first sign is not always panic. It is a weaker flow, a longer line, a higher bill, a nervous glance. By the time the fountain in the square runs dry, the problem began far away. That is why geopolitical risk is so powerful. It does not stay in the category called foreign affairs. It leaks into inflation, which means everyday prices. It leaks into growth, which means jobs and business activity. It leaks into markets, which means savings and pensions. And it leaks into politics, because voters feel the pain long before they hear the explanation. There is another reason this matters. Central banks can raise or cut interest rates. Governments can spend more or less, but neither can quickly reopen a blocked sea lane, end a war, restore a gas pipeline, or rebuild trust between rival states. When the shock comes from geopolitics, the usual economic tools are like trying to fix a broken bridge by adjusting the room temperature. This brings us directly to the first part of the story. In October 1973, a war in the Middle East triggered one of the clearest examples of geopolitical risk turning into economic trauma. After the United States resupplied Israel during the Yom Kippur War, Arab oil producers imposed an embargo. Oil production was cut, exports were restricted, and a basic assumption of the post-war economy was shattered. For years, many industrial countries had behaved as if oil would always be there, always move, and always stay cheap enough to build an entire way of life around. Commuting, trucking, plastics, heating, fertilizer, aviation, suburban growth, factory design, military planning, all of it rested on that assumption. The world had built a mansion on top of a single fuel line. Then the line tightened. Before the embargo, oil sold for about $2.90 a barrel. By January 1974, it had climbed to $11.65, nearly 4 times higher in a matter of months. That kind of jump is not just a higher bill for drivers, it is like raising the price of blood in the middle of surgery. Everything connected to it starts to strain. In the United States, ordinary people felt the shock in ways that were painfully concrete. Cars waited in long lines at gas stations. Some stations simply ran dry. Families planned weekends around which pumps still had fuel. Small businesses saw transport costs surge. Farmers paid more to run machinery and move crops. Heating bills rose. Grocery bills rose. The same dollar that bought a full bag of necessities began coming home with less inside it. And this is where history gets uncomfortable. The oil shock did not hit a calm system. It hit an economy already dealing with inflation, a weaker dollar, and supply strain. That mattered. A geopolitical shock is rarely dangerous only because of the event itself. It becomes dangerous because it lands on dry timber. One spark in a wet forest dies. The same spark in a dry forest becomes a wall of flame. That is what happened in the 1970s. Higher oil prices fed inflation. Inflation made policymakers choose between painful options. If they tightened policy too much, growth would slow. If they did too little, prices could keep climbing. The result was a mix people hate most: weak growth and high inflation at the same time. It felt unnatural because most people were used to one problem or the other. Now they had both. Look at the mechanism clearly. A military conflict changes state behavior. State behavior changes commodity flows. Commodity flows change input costs. Input costs change consumer prices and business margins. Then fear spreads through expectations. Workers ask for higher wages because life costs more. Firms raise prices because their own costs are uncertain. Households cut spending because they feel poorer. The shock moves from tankers to kitchens to balance sheets. And who was hurt first? Not the people with the best information, not the people with hard assets, pricing power, or political access. It was the commuter who had to get to work. The restaurant owner paying more for deliveries. The family choosing between heating and saving. The small operator whose business model had no room for a sudden jump in fuel costs. In every crisis like this, the first victims are often the people living on routine. Routine is wonderful when the machine works. It is fragile when the machine changes shape. The lesson from 1973 was not just that oil matters. Everyone knew oil mattered. The deeper lesson was that geopolitics can reprice an entire economy faster than most domestic policies can respond. A cabinet meeting in one capital, a production cut in another, a war in a third, and suddenly millions of people who never read a foreign briefing are rearranging their lives. Now here is where it gets interesting. In 1990, the world saw a second version of the same logic, but with a different texture. On 2nd August 1990, Iraq invaded Kuwait. The military action was immediate. The economic effects were too. Oil prices surged. By the end of that year, the Bank for International Settlements noted that the rise in oil prices was associated with slower output growth or deepening recession and somewhat higher inflation across many industrial economies. Here's something I want you to think about before we go further. When a crisis begins far away, what reaches households first? The real shortage or the fear of the shortage? Drop your answer in the comments, seriously, because what comes next is the part of this story that most people miss. And once you see it, you start to understand why markets can fall before shelves are empty. The 1990 shock mattered because it reminded the world that uncertainty is itself an economic force. Not just missing barrels, not just disrupted exports, uncertainty. Businesses delayed investment because they did not know where prices were going. Consumers turned cautious because they did not know what the next month would cost. Lenders and investors pulled back because the horizon grew foggy. A geopolitical crisis does not need to destroy everything in front of you. Sometimes it only needs to make tomorrow unreadable. That unreadability has a price. Factories in oil-importing countries faced a terms of trade loss, which means they had to give up more real income to buy the same energy from abroad. Households felt it through fuel and heating. Airlines faced rising costs. Trucking faced rising costs. Producers saw margins squeezed from both sides, with input costs going up while customers were less willing to spend. Like a vice tightening, geopolitics can squeeze supply on one side and demand on the other. And once again, the timing made it worse. The global economy was not stepping into the Gulf crisis from a position of perfect strength. Some major economies were already slowing. Confidence was already soft. That is why history so often punishes people who only look at the size of the shock and not the condition of the system receiving it. A hammer dropped on stone makes a noise. The same hammer dropped on cracked glass makes a break. Ordinary people rarely describe this in technical language. They describe it in moods. Customers stopped coming in. Overtime dried up. The boss stopped ordering new equipment. The bank manager sounded different on the phone. That is how macroeconomics, which is the big picture of the economy, enters daily life. Not as a chart, as a change in tone. The Gulf crisis also showed something else. Markets react not only to what is happening, but to what they think governments might do next. Will more oil supply be lost? Will the conflict spread to Saudi Arabia? Will shipping be disrupted further? Will inflation force tighter policy? Each question becomes a cost. Insurance costs, hedging costs, inventory costs, borrowing costs, emotional costs. Fear is not a side effect. In these moments, fear is part of the transmission belt. This leads to the second part of this story. If the 1970s taught the world that geopolitics can hit inflation through energy, and 1990 taught the world that uncertainty can deepen the blow, the years after Russia's full-scale invasion of Ukraine in February 2022 showed how wide the blast radius can be in a deeply connected economy. At first glance, many people saw it as a regional war with tragic local consequences. It was that. But it was also much more. Russia was a major energy supplier. Ukraine was a major agricultural exporter. Together, Russia and Ukraine had accounted for about 34% of global wheat exports in the years before the war. That means a war in one region could affect not only heating and electricity in Europe, but bread prices and food security far beyond Europe. This is where the map turns into a mirror. In Europe, energy prices surged. The European Central Bank said in October 2022 that very high energy prices were still the main reason inflation remained far too high. Euro area inflation reached 10.6% that month. Think about what that means in family terms. Every paycheck was standing on a treadmill that had suddenly sped up. You could still run, but you were losing ground. Gas supplies became a source of anxiety. Industry faced the possibility of rationing. Households feared winter bills. Governments scrambled for alternative supplies. Companies that had built their cost structures on predictable pipeline gas had to rethink their future almost overnight. Fertilizer prices rose. Food producers faced higher energy and input costs. The shock traveled through power, transport, farming, chemicals, metals, and household budgets all at once. Ukraine's role in food exports made the problem even wider. After the invasion, exports through Black Sea ports collapsed. Wheat prices in March 2022 were 58% higher than a year earlier, and grain prices were 34% higher. For wealthier households, that meant an unpleasant jump at the supermarket. For poorer countries dependent on imports, it threatened something more severe, food insecurity, which means not knowing whether enough food will arrive at a price people can afford. Look at what happened next. Ukraine's wheat exports dropped by more than 90% in March, April, and May 2022 compared with the year before. Farmers sowed less land. Facilities were damaged. Routes were blocked. The Black Sea Grain Initiative later eased some pressure, and overland routes helped, but the lesson remained. When a war strikes a node that supplies energy, grain, fertilizer, and transport routes, the economic consequences travel like cracks through ice. They spread farther than the point where the stone landed. And ordinary people felt this in ways that do not show up fully in headlines. A bakery in Germany paid more for power. A pensioner in Italy saw higher food and heating bills eat into a fixed income. A farmer in Africa paid more for imported fertilizer. A family in Egypt watched bread become more expensive. The system did not need to fully break to become punishing. It only needed to become less forgiving. This is why geopolitical risk now feels larger than in many earlier decades. The modern economy is more optimized, which means it has been designed to run fast and lean. That looks efficient in good times. In bad times, it can feel like a racing bicycle on a road full of nails. There is less slack, less spare capacity, less tolerance for interruption. One broken link no longer stays local for long. There is also a political layer that earlier generations felt less intensely during the long calm after the Cold War. Sanctions are broader, export controls are stricter, governments talk more openly about strategic autonomy, which means trying not to depend on rivals for critical goods. Companies hear phrases like friendshoring and nearshoring, which sound technical, but really mean something very old. Move your lifelines closer to people you trust. That shift can make supply chains safer. It can also make them more expensive. And expense is not a side story, it is the story. If a company replaces the cheapest supplier with a safer one, that may reduce risk in the long run, but in the short run, it often raises costs. New factories must be built. New logistics contracts must be signed. New workers must be trained. Warehouses must hold more inventory. Insurance models must be rewritten. It is like rebuilding a ship while sailing it through rough water. The work may be necessary. It is still costly. This is one reason the economy now reacts so strongly to geopolitical tension. The world is not only vulnerable to disruption, it is already paying to become less vulnerable. Defense budgets rise, energy systems are rewired, trade routes are duplicated, strategic reserves are rebuilt. All of that may improve resilience over time, but none of it is free. Geopolitics is no longer just a source of sudden shocks. It is becoming a permanent line item. Now observe what all of these cases have in common. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you are still here, you are not most people. Hit subscribe, because the next section is the part this channel was made for, the part they never put in textbooks. The same mechanism, different countries, different decades, same result. In 1973, war and retaliation hit oil flows. In 1990, invasion and uncertainty hit oil prices and confidence. In 2022, war hit gas, food, fertilizer, transport, and inflation across continents. The names changed, the flags changed, the technologies changed, but the structure underneath barely changed at all. First, a geopolitical event hits a choke point. That choke point may be oil fields, pipelines, grain ports, shipping lanes, payment systems, or financial centers. Second, prices jump or routes harden. Third, finance reprices risk. Insurance rises. Credit tightens. Investors retreat. Firms hold back. Fourth, ordinary households absorb the cost through prices, lost confidence, weaker wages, or slower hiring. By the time the story reaches the evening news as an inflation problem or a growth problem, the original force was often geopolitical. This is why saying geopolitics is now the biggest variable in the economy is not dramatic. It is descriptive. A variable is simply the thing most capable of changing the outcome. And today, geopolitical shocks can alter energy costs, trade routes, industrial strategy, defense spending, migration, supply chains, sanctions, food security, and capital flows all at once. That is not one lever, that is a fist closing around the machine. The International Monetary Fund has warned that new trade restrictions have more than tripled since 2019. That matters because every new restriction is a small wall, and enough small walls can turn a global marketplace into a maze. Trade between countries aligned with different geopolitical blocs has been weakening relative to trade within the same bloc. In plain English, countries are becoming more careful about who they depend on. The world is not flat when trust breaks down. It becomes lumpy, political, and expensive. Now look at all three together and one truth becomes impossible to ignore. Geopolitical risk is not just about war headlines, it is about the price of dependency. If your factory depends on a fuel you do not control, a route you cannot defend, a supplier sitting near a conflict zone, or a payment network that can be weaponized, then your balance sheet is partly a foreign policy document. And this is where history gets even more uncomfortable. The people hurt most are usually not the people who made the system fragile. When the pipelines strain, the first to feel it are middle-class households with fixed routines and little margin for error, pensioners living on fixed incomes, small business owners who cannot pass every cost increase to customers, workers whose wages adjust slowly while prices move fast, renters who do not own assets that rise with inflation, farmers who need diesel, fertilizer, and credit all at once, families in import-dependent countries where food and fuel shocks arrive like a tax nobody voted for. Think back to the people in Britain in 1914. Many were not speculators, they were savers. Yet when fear rose, banks rationed gold payments and queues formed. Their problem was not that they had made a grand strategic mistake. Their problem was that the system they trusted suddenly cared more about preserving liquidity, which means ready cash, than preserving normal life. Think of American drivers in 1973 waiting in gasoline lines. The executives with access, the large players with contracts, and the people with political reach had buffers. The everyday commuter did not. Waiting became a form of payment. Time itself became currency. Think of households in Europe in 2022. Wealthier families complained and adjusted. Poorer families cut consumption. They turned down heating. They delayed purchases. They leaned on savings. The same rise in prices can feel like a headwind to one class and a wall to another. History is full of moments when a 10% shock in theory becomes a 20% shock in lived experience because poorer households spend more of their income on essentials. And then there are countries on the wrong side of global dependence. In parts of Africa and the Middle East, higher wheat prices after the invasion of Ukraine were not merely a budgeting problem. For some communities, they were a stability problem. Bread has toppled governments before. Food inflation is never just economic, it is social weather. Now add the Red Sea disruptions of late 2023 and early 2024, and the present starts rhyming loudly with the past. Attacks on vessels in the Red Sea helped cut Suez Canal trade by about 50% in the first 2 months of 2024, compared with a year earlier. Delivery times increased by 10 days or more on average as ships rerouted around the Cape of Good Hope. Shipping costs in the region rose about 180% from late October 2023 to late January 2024, while global freight rates rose around 120% from late October levels. This matters because the Red Sea is not an abstract place on a map. It is one of the narrow throats through which global trade breathes. Roughly 15% of global maritime trade normally passes through the Suez route, and the broader Red Sea corridor is critical for container traffic between Asia and Europe. When ships divert, fuel use rises, insurance rises, inventory risk rises, delays compound. It is like forcing half a city's traffic onto side streets and then pretending the main highway does not matter. Who feels that first? Not the spreadsheet. The business waiting for parts, the retailer restocking late, the hospital buyer paying more for supplies, the manufacturer with just enough inventory for 6 days, not 16, the small importer who cannot negotiate better terms, the family that meets the final price only after every extra mile, every insurance premium, every delay, and every hedge has already been added. And who walks away relatively fine? Usually the same kinds of actors. Large firms with pricing power, which means the ability to raise prices without losing too many customers, exporters selling scarce resources, companies with flexible supply chains, governments that control domestic energy, investors and institutions holding assets that adjust faster than wages. In every era, the shock behaves like rising water. The tall structures still get wet, but the low ground goes under first. This class divide is not incidental. It is built into how these shocks spread. Essentials like food, fuel, transport, and rent take up a larger share of income for poorer households. So the same geopolitical event lands unevenly across society. A 10% jump in shipping or energy costs may be absorbed by a wealthy household as irritation. The same jump can force a low-income household to cut meals, miss payments, or take on expensive debt. History often records the average. Ordinary people live the edge. You can see the same split at the national level. Countries with domestic resources, reserve currencies, stronger institutions, or room to subsidize households can cushion the blow. Countries that rely heavily on imports and have weak fiscal space, which means little room in the budget, are far more exposed. They cannot print trust. They cannot summon grain ships out of thin air. They cannot talk insurers into lowering war risk premiums. When geopolitical risk rises, weak states do not merely pay more, they lose choice. This is why analysts who focus only on central bank rates can miss the deeper story. Interest rates matter. But if ships must take the long route, if gas must come from farther away, if wheat is trapped in port, if sanctions freeze payments, then part of the price system is being set outside the normal domestic cycle. The thermostat in your house still matters, but not as much when someone is opening the windows in winter. At this point, the pattern becomes impossible to ignore. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. So what did the survivors do differently in periods like these? Not the lucky speculators, not the insiders with government phone numbers. The ordinary people, firms, and communities that came through with the least damage. The historical record shows that those who came through these periods largely shared 3 characteristics. First, they respected dependency. They understood what their livelihood relied on. A business that knew its energy exposure, supplier concentration, shipping routes, and financing risks was less likely to be blindsided. A household that understood how much of its budget was exposed to fuel, food, or variable borrowing costs was better able to adapt. Awareness did not remove the shock, but it turned a sudden punch into an anticipated storm. Second, they valued resilience over maximum efficiency. That means they kept more margin than the culture of boom times considered fashionable. More inventory, more cash, less debt pressure, more than one supplier, more than one route. In easy years, this can look old-fashioned, like carrying an umbrella on a sunny day. In hard years, it looks like wisdom. Third, they were psychologically flexible. This may be the least discussed trait and one of the most important. The people and firms that survived best were often the ones willing to change routines early. They did not cling to the old map after the river moved. They cut exposures, found substitutes, reduced waste, delayed vanity projects, and accepted that the world had changed before the official narrative caught up. Notice what is missing from that list. Perfect foresight. Nobody had that. The London saver in 1914, the American driver in 1973, the European household in 2022, the importer facing Red Sea delays in 2024, none of them had a crystal ball. What mattered was not predicting the exact event, it was recognizing the structure. Long supply chains can become brittle. Cheap inputs can become political. Financial calm can disappear faster than physical production. And governments under stress do not always optimize for your comfort. They optimize for survival. That is why the winners in these periods were often not the smartest in the room in an abstract sense. They were the least surprised by human nature. They assumed fear would spread. They assumed states would intervene. They assumed choke points mattered. They assumed the map could reach into the household budget. In other words, they remembered that economics is never just numbers. It is people making hard choices under pressure. Which brings us back to London in the summer of 1914. You are that shipping clerk again. The small tin box on the mantel is still there, but it feels different now. What looked like savings has become exposure. What looked like routine has become dependence. The ships that tied your neighborhood to the world still float, but the world around them has changed shape. That is the final lesson. The economy is not a sealed machine operating in peace beneath politics. It is politics, geography, energy, transport, food, finance, and fear woven together. When the weave is tight, we call it stability. When one strand snaps, we call it bad luck. But history shows that repeated economic pain often begins the same way. With dependence, people forgot they had, meeting geopolitical stress they thought was someone else's problem. So when you hear that inflation is high, or growth is slowing, or trade is fragmenting, ask the deeper question. What changed upstream? Which route hardened? Which resource became strategic? Which state decided economics could be used as leverage? Follow that trail and the picture sharpens. Ignore it, and the economy looks random when it is not random at all. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it. But if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.